So learning objective 4 talks about how stockholders' equity is reported on the balance sheet. And then we'll also look at a little bit of analysis that we're going to be doing. But first things first. As you know, stockholders' equity has two parts to it, right? Paid in capital, which is the owners putting money in exchange for shares of stock, whether that be common stock or preferred stock. It's still paid and they're paying in money to get ownership. And then there's retained earnings, which, as you know, retained earnings is all about the profits of the company. We had this discussion many moons ago, and I said, who owns the profit of a company? The owners do, right? That profit belongs to the owners. So in a corporation, it belongs to the stockholders. And so retained earnings is a stockholders' equity account because the profits of the company belong to the owners. Now, the retained earnings are the amount of the profit that's been retained in the company, not given out by a dividend, right? So that's a big part of it. Retained earnings is, as you know, all of the times the company has a profit, that gets added to retained earnings. But when a company has a loss, that gets subtracted from retained earnings. Okay. And so one of the questions that comes up is, can retained earnings ever be below zero? What if a company never has a profit? What if they continually operate at a loss, which happens quite a bit, in fact. Amazon was operating at a loss for several years before they turned their first profit. So it's not like it's an uncommon thing that happens. Well, basically speaking, you can have a debit balance in retained earnings because that is considered a deficit. So you can have a retained earnings deficit, or as you'll see, there's other names for it. So retained earnings is a very interesting account in that regard. Here you have a partial balance sheet for Groupon, in which case they might need a Groupon to get out of Groupon. And here's their stockholders' equity, where you see the paid in capital, right? Common stock and its par value really low, and paid in capital in excess of that, which is very high. So their paid in capital is quite large. This company, up until the dates here, I don't know what the date this is, they haven't had any retained earnings. In other words, they continue to operate at a loss. So who covers the losses? The owners. The same thing. The owners benefit when the company is profitable. That makes them richer. However, when a company loses money, only the owners can cover the loss. Okay. So here what you see is retained earnings is in what we call an accumulated deficit, which means that this company, Groupon, up until whatever date this is, has lost nearly $1 billion. Okay. Because right now this is 921 million, because you have to add 3 zeros to all these numbers. So up until the date of whatever this was, Groupon had lost a cumulative loss of $1 billion. So that's basically income statements that continually show losses that have added up to now close to $1 billion. Who covers the losses? Well, clearly the owners do, and they're covering it by their paid in capital. So the amount the company has raised from owners through stock is covering the loss that the company has been incurring since it started. Okay. So their total paid in capital is affected by that loss. Interesting enough, Groupon has treasury stock, right? Because they probably, as a smaller company that's trying to grow rapidly, has probably promised their executives quite a few stock options to make the company profitable. So their total stockholders' equity is much lower than what they raised. Okay, but this is what happens with companies that They raise a lot of money. That's usually through stock, but they burn through it because they're operating at a loss. You see that happening all the time. Excuse me. The airlines have been doing the same thing. They've been raising money simply to burn it because they have operating expenses. They're not making a profit, but they have all these operating expenses they have to pay. So they're operating at a loss. Only certain companies can do that. So what can retained earnings be used for, or are there any restrictions on them? There are some. In some cases, retained earnings can be put aside specifically for any contractual restrictions that they have. So for example, here on the notes to Tektronic, they have a debt agreement. So they have a contract as part of a debt covenant that they have to put aside a certain amount of retained earnings to meet that obligation to their bondholders. So that's a restriction on what retained earnings can be used for, because a lot of people say, okay, remember, retained earnings are the profits that are being kept in the business. And you ask them, what do you want to do with those profits? They're all going to say, let's reinvest it in the business. Okay, which basically brings, as we know, buy more assets. Sometimes you can. Sometimes there are restrictions on those retained earnings because of the other obligations that you might have. In this case, for Tektronic, the obligation is with their bondholders, and they have a restriction on what they can use that money for. Okay. So let's shift over to paid in capital. Again, this is the word paid in, means the owners are paying money in. They're putting cash into the business. They're getting back shares of ownership, right? Stock. So we have classified paid in capital by looking at their shares of stock, capital stock, their par, their legal value, plus any additional paid in capital over and above that par or legal value. So that's how we classify paid in capital. Another thing that we look at this for balance sheets that have an effect, and this is sort of a note outside of this, we've talked about comprehensive income when we've looked at the multi-step income statement, for example. And comprehensive income can sometimes affect things for profit and loss in total, because in this case, they have to make certain adjustments based on their pension plan assets, or they have to account for gains and losses either on investments or currencies. All of these things would affect, in essence, owner's obligations that they would have. Okay. But again, we're going to keep that sort of as a separate note, but it is part of the slide. So here's what we have to read. This is what I was telling you. It looks like a lot, but it's actually, if you break it down a little at a time, it makes perfect sense. So I'm going to be teaching you how to read this so it makes sense to you. So detailed balance sheets, particularly for stockholders' equity, do look like this. And they always start with paid in capital. And the first thing about paid in capital is always their capital stock. Notice they have capital stock and additional paid in capital sort of listed as two categories of paid in capital that we looked at the other slide. So first things first, capital stock. What's their capital stock? Well, they have preferred stock. Preferred stock, if they have a company has it, is always going to be listed first. Common stock will be listed after that. Again, not everyone has preferred stock. So a lot of times the capital stock will just start with common stock. That's it. But in this case, this company has 9% preferred stock, $100 par value, cumulative. They have 10,000 shares authorized, but 6,000 shares have been issued and they are outstanding. Remember, these terms are really important, right? So they have 10,000 shares authorized, so legally authorized, but they've only issued 6,000 of those shares, and they're all still owned by the public, all 6,000. So their capital stock is 6,000 shares times $100 par value. So their preferred stock capital stock value is 600,000. They clearly raised more money than that. And that's going to be in the additional paid in capital for preferred stock down in the additional piece here. So any money they raised over and above 600,000, which is the par, will show up in the paid in capital in excess of par for preferred stock. So clearly they raised a good amount of money here. The second thing they show is common stock. This common stock is no par common stock. However, they have put a $5 stated value on it. Again, for accounting purposes, stock should have either a par value or a stated value. Okay. Why? Because we can value our capital stock. 500,000 shares authorized. So that's the legally recognized amount of shares the company has in common stock. 400,000 of those have been issued. So that means 400,000 of the 500 have been sold to investors to raise money. However, only 390,000 of those shares is still outstanding, which means they're still owned by the public. So you have 4,000 shares issued at $5 par value, stated value. That's your $2 million capital stock. So total capital stock is the par value of both the preferred and the common stock added together. They clearly raised more money than this because here they have paid in capital in excess of stated for common stock. Okay. So now their total additional paid in capital is all the money they've raised above the par or stated values, which are totaled here is 1,080,000. Together, they make total paid in capital. So the capital stock plus the additional paid in capital is the total paid in capital. Okay. So that's how we would read that. And that's just for stock. Here, it's all stock. Okay. The next thing is retained earnings, relatively easy. You would see a balance. The note here would show both how the balance might be calculated. In addition, here they're telling us that certain portion of the retained earnings is restricted. Okay. So here they have retained earnings of $1,050,000. And here is the total paid in capital in retained earnings, $4,730,000. However, a couple of things to note. They have some other comprehensive income. So again, adjustments to pension plan assets, any gains or losses from currencies or other investments that they might have had is going to go down here because it belongs to the owners, 110,000. That would usually be given to you. Again, they subtracted out the 10,000 shares. How do we know it's 10,000 shares of treasury stock? Because if you have 400,000 shares issued and 390,000 outstanding, the difference is treasury. The difference is going to be treasury. And here they are, 10,000 shares treasury. $80,000 here, that gets subtracted, right? Treasury stock basically is dead stock. So it's taken away, dead capital. So that leaves total stockholders' equity as a difference. So you have to know, again, how to read all of this. Again, step by step. I don't think it's that. It takes a little while to get used to, but it's not terrible. It's not terrible. So that's how Learning Objective 4 starts. They want you to really understand that stockholders' equity section of the balance sheet by doing a couple of them. So again, it's a matter of your capital stock gets put first, your paid in capital gets put second, and then your retained earnings is last. And if there's any comprehensive income stuff that they give you, that clearly goes last as well. So here they have Jennifer Corporation. They have they issued, so that's sold, 300,000 shares of $3 par common stock. However, it's authorized for 600,000 shares. Paid in capital in excess of par on the common stock is 380. The corporation has reacquired 15,000 shares. So reacquired means they bought them. That's treasury stock, 50 grand. And the company is currently holding those shares. And again, here it tells you they have cumulative comprehensive income, actually a loss of 82,000. So it's going to be deducted at the end. The corporation also has 4,000 shares issued and outstanding of 8% $100 par value preferred stock. It's authorized to issue 10,000. Paid in capital in excess of par for preferred is 97,000, and the retained earnings is 610. So organize this into what the stockholders equity section of the balance sheet would look like. Okay. So again, capital stock gets listed first. So the first thing you're going to do is capital stock, and there's two. Your 8% preferred stock, $100 par value. 10,000 shares they told you were authorized. So the authorized shares get listed first. 4,000 shares issued and outstanding. So they sold 4,000 and they're still outstanding. Now, if you have 4,000 at $100 par, you got 400,000 of preferred stock, capital stock. Your common stock is a $3 par value. They have 600,000 shares authorized. They have 300,000 shares issued, but they told you they bought 15,000. So only 285,000 are outstanding. Again, you have 300,000 shares issued at $3 par, 900,000. So your capital stock total is those two, right? The par values of both of those put there. Then you have all the additional paid in capital, and here they just gave you the numbers. Paid in capital in excess of par for preferred was 97. Excess of par for common was 380. So you add those together. Okay. Total additional paid in capital is here. These two together are going to be your total paid in capital. So they're going to add up to 1777000. You add then your retained earnings that they just give you, and that is your total paid in capital and retained earnings. And then you have to take into consideration that additional comprehensive income or loss. In this case, it's a loss. Subtract that out. And you have to take into consideration the treasury stock. Now here they have 15,000 shares, and they told you they paid 50,000 for it. We subtract that out. And the difference is, voila, total stockholders equity. Okay, so this is going to be the first thing that I'm going to be asking you to do, and I'm only going to have you do a couple of them, but just so you can sort of see how that structure works. Okay, very important to know. And again, chapter 4, learning objective 4 ends with some analysis. As we've known, the point of this class has been to understand that analysis better. So here we're analyzing what we call a dividend payout. How much of their income does a company share with their owners in the form of a dividend? That's basically a payout ratio. So a payout ratio is the amount of cash dividends for common stock divided by their net income. In other words, how much of their net income, not NEL income, net income do they share as a dividend with their common owners? That's it. So here we have, I don't know why they call this blank. Some of these slides are really funny. This is for Nike. And so here we have 2014 numbers here, 2013 numbers here for their dividends that were paid, and the net income or NEL income, as they have it here originally. And so basically speaking, that's your formula. And for 2014, you have $821 million of dividends on $2,693,000,000 of net income. So that's a 30.5% payout ratio. So they paid out 30% of their net profit as dividends. In 2013, it was a very similar story, 727 million of dividends on 2.472 billion of profits, 29.4%. They're very close, very close. Is this a good level? Yes, you don't want a company to be paying out everything, right? If you see a payout ratio at like 80%, 90%, I would say it's unsustainable. And I would even argue it could be stupid, because if the company is giving away its profits to its owners in the form of a dividend, what is it reinvesting in? Is the company committed to growing in any way, shape, or form? So I don't look at a low dividend payout ratio as a bad thing. It really depends on what the company is doing with their profits. This is quite sustainable. 30% is very, very sustainable. So that's all good, said and done. Another thing we look at is the earnings performance. How are stockholders doing when you compare the profits of the company to their equity in the company? And that we call return on common stockholders' equity. And it is, in essence, the comparison of the profits of the company, which is the net income. We do subtract any preferred dividends, but like I was saying, most companies don't have preferred stock, including Nike. So most of the time that's zero. So the net income divided by the average common stockholders' equity. So common stockholders' equity is on the balance sheet.
Where did they get the net income from?
That also would come, the net income is on your income statement. Right?
Okay.
The net income comes from the income statement. So, and I think that's what was listed here. Your net income was provided on the previous. Again, we're still looking at Nike, and here's the net income numbers. So it's still part of the same company that we're looking at here. But that's where those numbers came from, Adam. They've given you the common stockholders' equity for each year. Of course, this is an average, so you have to average those two. And you're going to have to average those two in order to find out. So for 2014, you had a profit of $2,693,000,000. You didn't pay any preferred dividends because you don't have preferred stock. You divide that over your average common stockholders' equity. The average is the 10,824 plus the 11,081 added together, divided by 2. And common stockholder equity is getting almost 25% return, which is awesome. I would say that's an awesome return on the equity for a company, for an owner. In 2013, they had a $2.4 billion profit. Here you have to average your common stockholders' equity between 2012 and 2013 to get that denominator, and that's 23%. Again, really good in both circumstances. Really, really good. Your book then goes on to explain, and we'll entertain this as a good topic. When a company decides to raise money, they have a choice, right? They can raise money by issuing more stock, or they can raise money by issuing bonds. Either way, that's how companies raise money. They either get money from their owners, or they borrow the money. They get money from lenders. So the decision that when a company needs to get money, this is what they're weighing. Do we take on more debt? Do we ask the owners for more money coming in? And so there are a lot of things to look at in this. One advantage, if they go with debt, if they decide to raise money by issuing bonds, the owners are not affected. to that degree because they don't have to put more money in. Bondholders don't have any voting rights. Owners have full control of the company. If they went with bond financing and they paid interest, it would be an expense. Bond interest is an interest expense. So it would lower the taxes that they would pay because they would have a lower net income. Dividends are not affected and they don't have any tax benefits because dividends are taxed. The other thing they would look at is this return on common stockholders' equity. That ratio matters to common stockholders. So if their return on common stockholders' equity would be higher if the company borrowed money, that might be a benefit as well. So there's a lot that they think about when they go ahead and raise money. They have to look at and compare, right, that return on the common stockholders' equity that we just looked at with the return on assets and their debt to asset ratio. They want to make sure that their financial ratios show benefits for the owners, yet good use of their assets. You can borrow money to buy assets, and those assets could really be profitable to have. So that might also factor in to the decision. And I'm not giving you any questions on this in your homework, but I think it's just an important thing to look at because you will be getting more of these as you go into upper level classes. So let me introduce it to you here. Again, I'm not testing you on it. There's no homework on it, but I think it might be interesting for you to know. How do they make those decisions? Borrow or ask owners for more money? Well, they make plans. So here's a company that's Microsystems. They have 100,000 shares of common stock. That's outstanding. $25 a share. They have no debt. They're considering, they need money. They're considering two plans. The first plan is to sell more shares of stock. Okay. If they sell more shares of stock, then you're going to have more owners. So these 100,000 shares, whoever owns these 100,000 shares, which now have full control of the company, will have company. They won't have full control of the company because there'll be more shares outstanding. So you dilute some of the owner's power that way by issuing stock. However, you can raise a lot of money. 200,000 shares at $25, as you see here, is a whopping 1.5 million bucks. Okay. So that's one. Plan B, okay, involves issuing $5 million of bonds, 12% bonds, so it's a very high cost, a lot of interest you're paying. The income the income, which is the profit before taxes, will be 1.5 million, and your income tax is 30%. So I wanted to do one thing here. Let's erase this piece because I circled the wrong thing. So for Plan A, if they issued stock, what would happen is not up here, but down here. I made the mistake. I just circled the wrong. So the common stockholders' equity, if they raised more money, if they sold 200,000 shares at $25 a share, they would raise another 5 million bucks. So that means that their current stockholders' equity would go from 2.5 million to 7.5 million. Okay, that's part of Plan A. If they just did stock, it would affect their equity a whole lot. Okay. If they went with Plan B, they would have an interest expense. So here they have a profit of 1.5 million in both cases. If they just issued stock, their net income would be quite high because nothing would change. If they issued bonds, they would have to pay an interest expense, which would lower their taxable income to 900,000 from 1.5 million. Their tax bill would be lower, but so would their net income. Their net income would be lower, but their owners would still have $2.5 million of equity. So that means their owners would get a return on that equity of 25%. If they went ahead and issued more stock, they would be more profitable. 1.1 million is a bigger profit than that. But their ownership would be diluted because now they would have $7.5 million of stockholders' equity rather than $2.5 million. So when you divide this 1 million of income into all these owners, you're only talking about 14% return. So issuing bonds in this case is better for the owners. The owners would say, yeah, take on more debt because even though your profit is lower than it would be in the case here, my return on my equity is higher. And so again, you're going to be learning this stuff as you go deeper and deeper. So here is chapter 4, learning objective 4 wraps up with the analysis here. Again, the important thing is to understand dividend payout ratio is important and return on common stockholders' equity is important. Okay, those two things you need to know. So here we have Sienna Corporation, sorry. They purchased 2,000 shares of treasury stock at the beginning of 2017 here. So here they have net income, their dividends on preferred, dividends on common, and then their equity, beginning and ending equity for common stockholders' equity. And they want you to compute the common stock return on common stockholders' equity. So the computation here for 2017, as you remember, is the net income minus preferred dividends. So net income minus preferred dividends divided by average common stockholders' equity. So the average is 2, the beginning and ending added together and divided by 2. So in 2017, their return on common stockholders' equity was 25%. As you see, the prior year, they had $110,000 net income, and they still paid $10,000 of preferred dividends, but their common equity was higher. And unfortunately, that led them to a lower return. 20% is still good. I still wouldn't be bothered by it, but 25 is better. So this is how they're going to make their judgments, looking at those returns and saying, the higher is better. All right, so 2 important things to remember. The how stockholders' equity is presented on the balance sheet is very important to know and to understand. So that's one. And the second thing is those 2 ratios that we just looked at, dividend payout and the return on common stockholders' equity. Critically important for this part. Okay.